Investors piled billions into companies that listed on the London Stock Exchange in 2017 in the hope of backing the Apple, Facebook, or IPOs of the future. The total value of money raised by initial public offerings, IPOs, on the exchange soared to £15 billion, marking a three-year high. This is, in part, attributable to the big rise in the number of newly listed UK firms to 106 last year, up from 65 in 2016. But while investing in a company tipped to take the market by storm at the earliest stage possible might seem like a no-brainer, buying when firms float is a complicated area. Valuing the company can prove difficult without a stock market track record, but at the same time valuations for flotations tend to be on the high side. They have their own set of risks and opportunities that must be carefully considered. Put simply, an IPO marks the first time the owners of a company relinquish a fraction of their ownership and offer it to the public in a fundraising exercise for business expansion. The term initial public offering is an Americanism, and traditionally in the UK it was referred to as flotation, or going public for this reason. Firms that have gone through this process are available for trading on public markets, such as the London Stock Exchange or NASDAQ. The process can be whittled down to 5 key stages. First is the announcement of intention to float, and the second requires the company in question to devise and release a prospectus outlining its business processes and risks. The application for shares begins at the third stage. This will remain open for a fixed period of time known as the offer period. Fourth, once the offer period expires, applications are finalized, and investors are allocated shares based on how much money they have pledged and other relevant scaling. Finally, the company lists on a specified stock exchange and can be bought and sold like any other share or investment trust during normal market hours. Modest investors often find they can't buy shares direct in a company at IPO because shares are limited, and that larger institutional investors are favored by the company. A way around this is to be a customer of the group of brokers involved in the application stage of the process, or an online D platform or other brokers that have received an allocation to share with their clients. Alternatively, an investor could wait until the company has officially floated, at which time, demand for the share could inflate prices and result in overvaluations. Conversely, an overpriced IPO leaves little room for growth, and negative company news could send your investment tumbling. You need to consider the reasons for listing and the finances and business plan behind a company to see if it is worth putting money into an IPO. Doing your homework on established stocks is hard enough as it is because company reports and accounts are often littered with technical and investment jargon that can be difficult to decipher. Leading investment banks such as Goldman Sachs and Morgan Chase boast scale and credibility, so they can afford to be choosy with the companies they underwrite. Whereas smaller rivals may adopt a more liberal approach. This is not to say that the former are immune to bringing bad quality companies to the public. One year's fashion fad can be next year's tank top, so you have to be really convinced about the business case and in it for the long term. Of course, if the company is successful, an investor can always invest at a later stage, but they will likely have to stomp up more cash to reflect the company's success since IPO, he added. As ever, investors need to take a long-term view. More said. And if your recently bought IPO falls to a discount to net asset value, remember that if the share price is higher than what you paid, you've still made money, sometimes more so than if you had sat on your hands waiting for the fund to fall to a discount. Another positive is there is no stamp duty to pay, usually 0.5%, if you subscribe to a new issue of shares in a company, and stockbroking commission payable on IPOs, which reduces the cost of purchase compared to buying UK stocks on the market. What's more, most IPOs are available in an ISA and SIP, self-invested personal pension, which shield income and gains from your investment from tax. As with listed stocks, make sure you don't put too much money in one company and maintain a diversified portfolio.